Owner's equity is the owner's claim on a business after liabilities are subtracted from assets. In simple terms, it is what would be left for the owner if the business paid off everything it owes. The basic accounting equation is assets equal liabilities plus owner's equity. So equity is the balancing figure that shows how much of the business truly belongs to the owners. For a sole proprietorship, owner's equity is usually called owner's capital or owner's equity. It includes the owner's original investment plus any additional contributions, and it increases when the business earns profit. It decreases when the owner takes drawings, which are withdrawals for personal use. Because there is only one owner, the equity section is simple and usually has one capital account and one drawing account. In a partnership, equity is separated by partner. Each partner has a capital account and often a drawing account as well. The capital account shows each partner's investment and share of retained profits or losses. The drawing account records money or assets each partner withdraws. Partnerships may also track current accounts, depending on the accounting system, to show changes in each partner's equity more clearly. This separation matters because each partner's ownership interest may be different. For an LLC, the equity structure depends on how the business is taxed and organized, but it is often similar to a partnership if there are multiple members. The equity accounts may be called members' capital or member equity. Each member can have a separate capital account showing contributions, allocated profits, and distributions. If there is one member, it may look similar to a sole proprietorship, but the legal structure is different. In a corporation, owner's equity is usually called stockholders' equity or shareholders' equity. This section is more formal and often includes common stock, preferred stock if issued, additional paid-in capital, retained earnings, and treasury stock. Common stock represents the par or stated value of shares issued. Additional paid-in capital is the amount investors paid above par value. Retained earnings are accumulated profits kept in the business rather than paid out as dividends. Treasury stock represents shares the corporation bought back from shareholders, which reduces equity. So the name and structure of equity accounts depend on the business type. Sole proprietorships use capital and drawings. Partnerships use each partner's capital and drawings. LLCs use member equity accounts, and corporations use stockholders' equity accounts like common stock and retained earnings. Even though the labels differ, the purpose is the same: to show the owner's residual interest in the business.